Hi, everyone. This is Jason Burack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a first-time guest, but I've been following his work on financial Twitter for many years. He puts out great macro analysis, chart analysis for a very long time. He's a top-down macro analyst, investor, and trader. He also posts a lot of interesting articles on the stock market and the economy over at TraderAid.com and Macrovisor. Mayhem in Markets. Thank you for joining me.
Hey, how's it going, Jason? Thanks for having me.
Yeah, so we're for our listeners out there, you post your articles not under your real name. You post under Markets and Mayhem on Twitter. You have an enormous Twitter following, and you write these extensive articles. And you just started your YouTube channel. For our listeners who are wondering about your name and what you post under.
Yeah, exactly. So, I joined social media because I wanted to both share some of the knowledge that I've been able to accumulate over time, but also to be able to learn from others. And it's been a really interesting journey. And I never imagined that my Twitter account, of all things, would get as big as it has. But it's really cool to be able to share information on that platform and network with other people. And that's how we connected.
So to start the interview, and we're recording this interview on Tuesday, June 20th, 2023, the dollar index is at 102.54. I want to get your general view on asset prices and the global economy. So what do you think things are now, given what the Federal Reserve Bank has done with the rapid pace of the rate hikes and now the pause?
Yeah, I think that in terms of the monetary policy picture in the U.S., it's interesting that we're, just over 15 months out from the first hike that we had. And that impact has been, somewhat muted. This whole hiking cycle, as aggressive as it has been, the stock market SPX cash index is up over 100 points from just before that first hike in March of 2022. We've also seen, of course, QT, but some of that impact has been offset by the programs to help ensure that the banks have a lending facility for some of their less liquid qualifying assets like treasuries and agency mortgage-backed securities. So in doing so, between Treasury general spend and a suspension of issuance from January until really the last couple of weeks, and some of the offsetting flows from the People's Bank of China and Bank of Japan, we've had this liquidity-driven rally that's really more than offset the Fed's ability to meaningfully tighten financial conditions. In fact, financial conditions are pretty darn loose now. They're not as loose as they were before the Fed started tightening, but they're close. It's, again, one of those situations where you squint and you can barely see the effect that the Fed's had. And underneath the surface, within the realm of inflation, core inflation remains resilient. Whether we look at it in PCE, the Fed's favorite flavor of inflation, or CPI, we can see that there is, particularly concentrated in things like shelter, a pretty high amount of durability, of stickiness. And that has to do with some of the supply and demand imbalances in housing. And landlords still have pricing power to further raise rents. So this might be an issue we contend with for some time. So the Fed said, look, we're going to hike maybe 2 more times. And it's going to be data driven. Maybe July will be the meeting that we do our next hike. That's what the market is starting to think. But the market doesn't think there's going to be a hike after that. The Fed's, in my opinion, ever since February, been on a downhill journey for their credibility in terms of their monetary policy forecast. Now, we all know their economic forecast credibility is already in tatters after transitory inflation and so many other problematic calls. But their monetary communication was actually really, really good. Their policy, the way that they talked about things to set expectations in advance was actually the most transparent of any Fed in history. And so Powell's been increasingly transparent until February. And at that point, he started to say things like financial conditions had tightened meaningfully from the December meeting. And whether we look at the Chicago National Financial Conditions Index or the Bloomberg Financial Conditions Index or other measures, we can see that wasn't the case then, but it was the Fed, and he was visibly a bit anxious, kind of saying, we think there's something wrong. And there were some mentions of regional banks, and there were some mentions of concerns in commercial real estate. And of course, later we did see what played out, and it did give the Fed pause, and it actually prompted them to stand up that bank term funding program so that they could provide liquidity. And I think that the Fed's kind of stepped on their own toes, but they've also been fighting against the legislature, the Treasury, and the Bank of Japan and People's Bank of China, because the Treasury has, of course, been spending out of TGA for some time, but also the spending bills that have prompted that and prompted all that velocity of money from the government have been these late cycle stimulus bills like the ironically named Inflation Reduction Act as well as the Chips and Science Act. And these don't help to reduce inflation or increase supply in the short term. And so a lot of this stuff has been offsetting. And so I think that where we are in the asset market is kind of reflective of where we are in the macro picture. That is to say, the tightening by central banks has kind of been the greatest tightening cycle that wasn't, because we're not realizing those impacts in asset prices or in financial conditions or really in rates markets the way we should. And as a result of that, we've got this buoyancy. You have the NASDAQ up nearly 40% year to date, or at least off its lows. You've got the S&P up 24% off its lows. These are pretty big moves. They're concentrated in about 15 stocks that account for more than 90% of the upside year to date. There's been this sort of gravitation to larger and larger capitalization as a heuristic for safety and quality. And so we've seen that concentration. It's broadened a little bit, but not enough to tell me that this is a new bull market. And it's reminiscent of some of the head fakes we've seen in the past. It really reminds me of what we saw after the dot-com bust, where there was an S&P so-called bull market that grew over 20% from its trough. And we saw the NASDAQ actually 6 or 7 times after the dot-com bust go into new bull markets, like it did August of 2022 before it made a new low. We've seen this before. It's extraordinary what's happening now. The AI bubble has helped to drive it because there's so much hype and momentum behind this idea of pulling forward future returns for technological progress that might not be yet here in the present. It's a show me story. Suffice it to say, we need to see it in earnings. We need to see it in margin expansion and productivity increases. We haven't yet. In fact, productivity has been going down and margins have been compressing, and that's a different story. But the net is we're still in an earnings recession. We have 2 quarters of it. Looking ahead, we may have another quarter or two. We're likely to see a real recession later this year or early next, and that's not likely to be good for this market. So I think that we have this sort of last hurrah. I still think, even though it's gotten to be very extraordinary, it's not anything more than a very, very sort of drawn out bear market rally. So my outlook is, I think that a lot of the areas where there's been outperformance are great places to raise cash and hedge if one's going to keep positions on for various reasons like cap gains or otherwise. And then I think there's some short opportunities in some of these areas that have been drawn up with AI that aren't necessarily worth their valuations or don't have the kind of outlooks or even the exposure to AI that one might think. C3 AI is one name that comes to mind. Its run's been extraordinary, and I don't think the company is in as good shape or set up for as much growth as pricing and valuation suggest. And on the other side of it, I think it's a decent time to look at more defensive positioning. I love opportunities in fixed income. I love some of the defensive areas of the market. Healthcare has been one of the worst performers year to date, but overall, it's actually an area where there's some pretty good balance sheets, some pretty durable business models, and consumer staples also are starting to look a little more attractive in some of the areas that we see are pretty resilient pantry items that everyone has.
So in your video last week that was wrapping up the markets, you were talking about record call option buying on Thursday. Now, this wasn't just record call option buying over the last 12 months. This was the highest amount of record call option in the history of the data set, correct?
Yes, it was. And we've seen that in a number of different areas. So that particular one was for the S&P, but we've also seen that recently with the NASDAQ and the Russell 2000. So we've seen record amounts, just sort of kind of one after the other, and it's sentiment blowing out, it's positioning blowing out, and it kind of goes from the sentiment position, people get very bulled up, then the flows come in, they start to bid this stuff up, open interest starts to get really high, and then you start to see positioning get extended, right? And we're sort of at that last pit point now where the flows and the positioning have become very extreme, and it does start to flash some warning signs.
Do you think that call option buying, is that what's called gamma hedging?
So what's happening when we have a call run like that, because a lot of the calls that are being bought, about, let's call it 48% of volume in SPX, right? So just the index options for the S&P 500 are options that are going to expire in 6.5 hours or less. And so when you see that, there's actually a two-way street that's often going on underneath the surface. And this is what makes it quite interesting because, the S&P is a hedging vehicle by and large. For the options, there's usually a very large skew towards puts. And there's always some level of skew. There has been since the 1987 crash when it really did become a universal vehicle for hedging. And a lot of that hedging was expressed through options. So with that in mind, you go into the daily expirations and there's typically some tantalizing at the money put premium. And so what we've seen is not only is there, just out of the money call buying same day expirations, right? Which helps to create that gamma effect you're talking about, where you buy enough and the dealers start hedging and that drives price higher. Then you see buyers go back and they come in at the next strike and the next and they drive price up. We also see, however, as a part of those runs, people are selling, and we're talking about institutional size on both sides of these trades, selling put premium in SPX. So they'll sell at the money, which, if it goes against you, it's going to hurt. But they'll do that, and then they'll buy the call premium of just out of the money calls and walk those up. So it's very interesting. About 90% of this behavior is driven by algos, and it's largely institutions that are engaging in this activity. It has a major impact on the underlying in the S&P 500. Most of futures trading is happening from market makers, not other participants, but market makers hedging exposure because of the sheer magnitude of options trading.
Okay, so if I could summarize in more easier to understand terms for our listeners out there who aren't expert traders or expert at the options markets, these institutional investors and traders, now they're trying to set up kind of a hedge book so they're market neutral, or are they picking a direction with these options hedges?
The way that the participants are largely working in S&P options is they're selling downside insurance and buying upside exposure. So if you think about that, what they're doing, they're selling premium and puts, right? So they're saying, we don't think the market's going to go down. Then they're buying calls and they're saying, we think the market's going to go up, and we're actually going to lean enough on both sides to push it in that direction. And here's how that works. If I'm a seller of put premium, if I'm coming to you and I'm the contract seller and you're the market maker, and I'm saying I'm going to sell 100 contracts. So I'm getting out there, and now you as the market maker have to square your books. You need to be delta neutral, right? So that means that you're basically allowing me to sell those puts. So you're essentially getting exposure to puts, right? That means that you then have to offset that exposure, which means you are a net allocator of liquidity into S&P futures. So if I'm coming in and I'm selling puts, you have to balance out your exposure to those puts, which means that you're going to get some futures on your book. Now we go to the other side of the trade. And on the other side of the trade, you have calls. So let's say I'm buying from you calls. That means you're selling calls to me as the market maker. Well, when the market maker is selling me as a participant calls, the market maker has to hedge their exposure. So now you go out in the market and you buy more S&P futures because you have to. Because if you're going to pay out more for my call, then you need to have that exposure. And there's dynamics behind this where these things can change. But assuming that price moves in the direction of these participants' flows, right? So assuming price moves higher and not lower, then those scenarios don't come up. And essentially what happens is these flows of selling puts causes you, the market maker, to add liquidity into S&P buying futures. And then these flows of me buying calls from you, you're out there as the market maker also buying S&P futures to offset that.
So I think the average retail investor or trader is not understanding any of the stuff you just said, and they think that they're missing out. I guess it's FOMO, fear of missing out on the big move up. So you're seeing a lot of retail money now start to get very frothy with a lot of the meme stocks. It is back to risk on again for a lot of retail investors and traders. They are chasing. So a stock like NVIDIA, most of the people that are buying NVIDIA lately are not paying attention at all to the valuation. There's been record call option buying, record longs in NVIDIA, and people are trying to squeeze as much of the move to the upside. So buy high and sell higher.
Yeah, and we see it in a lot of different measures. So going back to sentiment, we had the AAII survey. It came in very, very high. I want to say the levels were the highest since August of 2021. Then we had, or maybe it was November. Yeah, November of 2021. I'm just looking at my notes here. Then we have Bank of America tracking retail flows, and they were also the highest since the second half of 2021. So we know where people's heads were. back then, right? And we know that there's also probably some level of, as we see sort of the back end of this rally where there is that FOMO, there is some level of probably some rolling off of positions by larger players, taking some profits into this and passing on the torch and basically saying good luck.
Yeah, I mean, institutional money, normally when they want to exit positions, they try to trick retail investors into going long, and then institutional investors offload large blocks of stock to the retail shareholders before they think the stock could crash or the general markets could crash.
Exactly. And so, I do concern myself a little bit with the concentrations that we see here. We have just seven stocks, those magnificent seven, or 28.2% of the total market capitalization for the S&P 500. And so for me, if I was constructive on this market, I would be more interested in the equal weight S&P than the market cap weight S&P. But I think there's also an interesting pair trade opportunity here. Assuming some reversion, assuming some normalization, it may be interesting to have a balanced trade of short the market cap weighted S&P and long the equal weighted S&P, because those other stocks, even if the market is going down because they didn't perform, perhaps we'll see those that outperformed actually have more of a fall to the downside, or at least not outperform in an environment if there's a continuation of this. Because if it is, let's just entertain the theory that it is a new bull market. If it is, then there has to be a broadening of breadth, right, to really quantify any kind of ability to continue that run. And for that to happen, we'd have to see the other 493 components of the S&P 500 broaden out their 2% year-to-date rally. Now, I don't think it's a new bull market. If it was, it'd be starting from the highest valuations in history for new bull. But, of course, anything is possible, and we have to entertain those theories. And so if it was a new bull, then, be careful what we wish for, right? Because at the end of the day, if the valuations are that high and stocks are in an earnings recession, so they're not likely to grow into them, then it might be one of those really short bull markets that we've seen going back in history. I think there was one in 1946 or 1947, got up to about 22% on the S&P, lasted about 394 days, and then turned over to a new low.
Have you ever seen in financial history examples of a U.S. stock market bull market with an inverted yield curve before?
I don't think I have. I haven't looked at it. I saw the tweet on earlier, and I was going to look at that. I think that certainly not in recent history, like probably not in the last 40, 50 years, because those are most of the charts that I'm looking at. But it would be a very interesting study to do. I think the other thing is we've got inversions across multiple different yield spreads. I mean, it's just such an interesting situation. And then on the other side of it, we talk about interesting dynamics in intermarket relationships. Risk premiums are the lowest they've been since 2001. And in many measures, they're inverted. It actually makes a lot more sense to be in fixed income than stocks.
And you have the VIX also down around 13. But normally, though, when the VIX gets this low, it may stay this low for a couple more months. But the analogy I use is it similar to an earthquake along the coastline a little bit before a tsunami. So normally the VIX doesn't stay this low for more than a couple months, and then something bad happens again.
Yeah, it's really interesting what's happening with vol too. It's become much harder to track through the VIX. The VIX has been good when options didn't expire every single day. I'm really waiting for a time where they expire every single hour. But I feel like that now that they're expiring every day, we have a different dynamic because we have so much more trading happening within the same day and then 3 days out. It's about 75% of all volume in SPX. And so what that does is it compresses implied vol because most of the positioning dynamics are near to the money or at the money, and they're close to expiration. So we have this vol compression effect. So then CBOE came out and they issued the 1-day VIX, right? And it's reading an even lower level. So it really isn't giving us much of a helpful guide. Some are saying, look at fixed strike vol. I think that's one area that we could look at if we really want to see what's happening in the at the money vol in the S&P, for example. But at the end of the day, I think that we're in this very interesting period of time because we have very low realized vol too. So if we go back 20, 30, 40, 50, 60 trading days, realized fall is extremely low as well. So there's no reason to be uncertain about price variance in the futures, which is what the VIX measures, which is what implied vol is about for all the folks out there listening. And so I think that we're in a period of complacency where it's somewhat warranted because there's been this relative sense of calm. But on the other side of it, this is when people get into bad habits, right? So we do see leveraging up in long positions. Hedge funds have the highest gross leverage they've ever had, but they're also increasing their net leverage. We have CTAs that are very, very long S&P and global equity exposure. And then we do have retail that are starting to pour back into positions. We have a lot of open interest in calls. In fact, it's interesting to look at single stock skew because we see more skew towards calls than puts in a lot of single stocks, really for the first time in the last month or two in over a year. And what does that mean? It means there's more demand for people looking for upside than downside. So that's a completely different dynamic, and it does suggest those changes in sentiment. So do the equity put call ratios, or basically how many calls to puts or how many puts to calls are traders buying in stocks. And we've seen those levels very low. What that suggests on average is there's almost 2-to-1 people trading in calls and puts. And that's very bullish. It's also very complacent in terms of the sentiment reading. It means that we're in a market that's basically discounted any risk of a recession, a Fed policy mistake, how bad things could get in earnings. And this is what I think, Jason. I think that we have had a very resilient economy in services. Manufacturing hasn't been so lucky. In manufacturing, you've had 9 months in a row sequentially of contraction. You've had 13 months in a row of new orders falling. You've also had 13 months in a row of leading economic indicators in the negative. Since 1960, of 6 or more months in a row of leading economic indicators in the negative, you get a recession at some point. You do. And it follows it usually within about 12 to 18 months. Now, on the other side of that, when we start to look at what's happening in the services industry, where there's about 3/4 of economic activity in this country, that's where the resilience is, but it's starting to wane. So the last ISM services PMI that came out was 50.3. That's barely in expansion. So it's good news for the economy because services hasn't gone into contraction yet. But it's bad news because when you look underneath the surface, you can see that it wasn't that healthy of a reading, that we're starting to see some slipping in new orders. And I think that what we're really looking for, and one of the things that we've talked about at MacroVisor, is when services starts to slip in contraction for 3 or more months in a row, we're likely to see unemployment follow. And from there, we're likely to see the economy slip, right? And so we've seen jobless claims up 30% year to date. There's some signs of weakness in the labor market, but it's not as pronounced, and we don't think it will be until services rolls over, which is probably not going to happen until just after the third quarter of this year.
The other major problem and reason I don't think this is a real bull market, although I think there is a lot of liquidity from other central banks and governments coming here to the U.S., kind of a mini dollar milkshake similar to 2019 during the last Fed rate hiking cycle, because global money supply numbers and the Fed relative to the other central banks, they've been very aggressive with the rate hikes and the balance sheet reduction, but the other central banks have not been aggressive at all compared to the Fed. So there's actually been a lot of liquidity that's ended up here in the US stock market, in my opinion. But I think this is not a healthy banking system right now here in the US and Europe, probably the US banks especially. I just see immense problems, lots and lots of red flags. We've seen a few small regional banks, but we did have the liquidity program installed, but I think there's a lot worse problems coming. Last week, we had the CEO for Goldman Sachs warn about large write-downs coming for commercial real estate. The chief financial officer for Wells Fargo had a similar warning last week as well. So I think the problems were really just in the first inning for commercial real estate problems. And, with the Fed rate hikes also, there's the banks, the insurance companies, the pension funds, they all have very large losses on older bonds in their bond portfolios for many billions of dollars that they really haven't written down yet.
Yeah, these are all really good points, and I'd love to talk about them some more because these are areas that we've been focusing on at MacroVisor. It's actually a topic I started talking about February 2nd. It was the first post on the MacroVisor website, and I discussed how we were seeing 3 things that concern me. And then there was an add-on that just kind of exemplified the theme. But the first was discount window borrowing in 2022, and it was growing. You never see that when everything is okay. And the second was that the capital buffers for banks were the lowest we've seen since 2006 in terms of percentages, which is not a good thing if there's any kind of unrealized losses on their balance sheet. And lo and behold, the last data from FDIC, which at that point I believe was the fourth quarter, or no, it was the third quarter. We're just about to get fourth quarter data not too long thereafter, March 1st. So the third quarter data of last year was showing us about $675 billion of unrealized losses in FDIC insured banks, right? So we knew there was a bit of a storm coming. And then the last part was just sort of the add-on of, oh yeah, year over year money supply is dropping, which means there's less money in the system for people to pay the interest on their loans. There's less money for banks to be able to lend out. There's less opportunity to make money. This is all a big concern as it comes to a debt-driven economy. And so we take that and look at what we had happen, right? What we had happen was more in the context of a liquidity crisis. It wasn't as much a solvency crisis. It wasn't as much a credit crisis. Things happened very quickly. The Fed stood up a facility. It helped to cushion things. But we've got to think about what this facility really does for a second, right? Because if I'm a bank, like let's say I'm First Republic, right? And so I've got $100 billion of outflows from my deposits, and I've got $40 billion of assets that I can use to borrow at that super discount window at 4.75%. So these assets are, not even yielding enough. I'm getting a negative carry cost on these things, probably 200, 250 basis points. So that's not so great. But the other part is I don't have enough capital to satisfy the demand of these exiting depositors because I don't have enough assets that qualify for it. And so here's where it gets interesting. All the stuff that is having the markdowns that's U.S. government backed, agency mortgage-backed securities, Fannies, Freddies, Ginnies, treasuries as well. That stuff's not as much of a concern, right? Because eventually, if you hold it long enough, it can mature at 100 cents on the dollar for one. But secondly, there's going to be a better aftermarket for that stuff. You might have to take a haircut, but there's always going to be some bid somewhere for that stuff. The difference with that and commercial mortgage-backed securities is you can get absolutely destroyed, just like we saw in residential mortgage-backed securities in the great financial crisis. If they're not properly rated, if they're not liquid, if they're not trusted, if there's trouble in the industry, and if there's a credit crunch. And we have all those things kind of coming up as headwinds as we get into the second half of this year. We've got an inordinate amount of commercial mortgage-backed securities and other debt, about 1.2 trillion, expiring and needing to be refinanced over the next year, from the second half of 2023 on to the first half of 2024. And this is coming at a time when credit conditions are tightening, where office vacancy rates are some of the highest we've ever seen, where retail delinquencies on rent are also coming up, where we're seeing a lot more stress in their loans, and where we're seeing some of the highest levels of delinquency month over month increases in commercial mortgage-backed securities since 2020. So I do think, and we're also seeing defaults. There's been some large defaults in San Francisco. I don't think that's the last we're going to hear about that, where basically the person who is borrowing, or the entity is borrowing, is giving the keys back to the lending bank saying, we can't do it. We can't make our payment. And they'll cite something like, low vacancy or low utilization rates, or, issues with attracting tenants or otherwise. But at the end of the day, what we're seeing is really just the early innings, as you aptly described it, of something that could get a lot worse. Remember, we saw with Blackstone the gating of their funds as well, because they didn't have the capital. And if you're a private equity group or any kind of REIT or fund and everyone's leaving, you've got to sell your assets, which means you have motivated sellers in the property market of these large, commercial buildings, which means they're going to take haircuts. I mean, there's cascade effects here if it does get bad. And so then who owns this stuff? Well, like you said, life insurers. You've also got 50% of all commercial real estate debt in the hands of banks, but 75% of that bank held commercial real estate debt is held by regionals. And some of these regionals are very concentrated in this stuff. So I don't think we're out of the woods. I do think we're going into a pretty significant credit crunch in a debt-driven economy with rates going up this high, this fast, but also capital becoming more scarce. The lagged and variable impacts of monetary policy just beginning to really hit. I think that we're starting to see some of those impacts that will accelerate in the second half of this year. And maybe it prompts the Fed to intervene again or in other ways. But at the end of the day, these are areas of structural vulnerability in a country with 350% total public-private debt to GDP, where a fair chunk of it is going to need to be refinanced or is revolving and is just rising as interest rates do.
This definitely reminds me of 2005, 2006, 2007. And last cycle, that was residential real estate and all the mortgage-backed securities and the derivatives tied to that. And that took down the banks, and there was strategic defaults, and the banks got stuck with all those homes for a while before BlackRock and the hedge funds were given artificially cheap loans to go and buy entire streets of houses in a bunch of different states. But this cycle, it seems like commercial real estate is going to be the problem point. But we are seeing bad news headlines every single day, and it's in almost all the major metro areas: New York City, Washington, D.C., San Francisco, Houston, Chicago, pretty much across the board. But it hasn't resulted in wide-scale bank failures, but it definitely is reminiscent of 2005, 2006, 2007 because of the bad headlines. But we haven't seen the cascade effects, like you said, the dominoes, where it starts taking down a bunch of different banks, and then you have counterparty failure and the banks stop trusting each other. We haven't had that yet.
Yeah, and I think that that's something that if it is going to happen at all, it's going to happen as we see these refinancing requirements start to kick in. Because, look at it from the perspective of the debtor and the creditor. If you're out there and your cash flows have diminished materially and you're coming hat in hand to the bank who's already got too many loans on its books, it doesn't want to lend, and it certainly doesn't want to lend to someone who's got a lot of risk, there's a very high likelihood of a default there. Then you can describe a lot of landlords in office buildings, but also in retail and quite frankly in some of these warehouse spaces as well, because we've seen a drop in e-commerce in similar positions. And so I do think it suggests that we could start to see a situation where, when this kind of wind picks up, when you start to see a series of potential defaults, that could turn into more of a cascade. And that could be where there is some contagion risk in the commercial real estate market as it pertains to regional banks and some of the other industries that have heavy exposure there, like life insurers. And I think that's something where it's a little different. It's harder for the Fed to step in because it's, again, a question of what is this stuff even worth? And, is there a market for it? Or are we just soaking it up to avoid another type of crisis, right? A solvency crisis. And so it's going to be interesting to see how this unfolds. But this is one of the dominoes that is certainly more likely to fall as we progress to the end of this year. And unfortunately, it's one of several. The problem is that we're kind of spinning plates right now, which is what makes some of the things that are happening in the market so incredible. Because underneath the surface, the picture looks a lot different than maybe what's being priced in by risk assets.
Yeah, I 100% agree with the asset prices, the way they're acting versus all the fundamentals of the real economy, the banking system, and then even recently the Treasury general account refilled, because wouldn't that be a net liquidity drain on potential asset prices?
Yeah, it's interesting because we've seen funds coming out of bank reserves and of deposits as a part of this. So we do see aggregate liquidity. Reserves are going down. RRP has not dropped as much as TGA has risen. So we definitely can, just with very simple models, say that liquidity should be starting to come out. We also saw PBOC cut rates, but it didn't do much to stimulate markets. And a lot of the stimulus that they're doing over there is more and more likely to be absorbed over there with some of the growing problems in their real estate and construction markets. Over in Japan, their market's running away, but now investors are more likely to start actually unwinding carry trades and putting them to work in Japan. So that could actually take liquidity out of our market and, put it back to work in the Nikkei and some of the other areas where we're starting to see some pretty significant outperformance. So I do think that we are likely to see that liquidity drain effect kick back up, and the Treasury issuance combined with QT starting to matter again is going to be a big deal, in my opinion. And some of these impacts are likely to be delayed. And I know we're in a market right now, and we have been for the last 3 years, where if something doesn't happen in the next 5 minutes, it's automatically some sort of, gloom and doom perma-bear theory that has no relevance in reality. But the fact of the matter is that a lot of this stuff takes some time to play out because there are systemic effects that travel through the financial system. And I think with liquidity dropping out a bit, particularly not only because of what's happening with Treasury issuance and QT starting to matter again, but also because summer has that effect on its own, I think we are likely to see higher levels of realized and implied vol start to come back as well, and some greater pressure on risk assets and maybe a re-rating of that risk, particularly as we start to see for Q2 earnings season that, we're not really seeing the kind of improvement that perhaps is being priced in.
I also think the large US banks and the regional banks know the liquidity programs to tap that's even away from the Fed discount window. So if people are looking at TGA refill and saying that that should be a net liquidity drain, they also don't pay attention that the FHLB program, which is connected to like the FHLA and other parts, the banks have already started ratcheting up the borrowing from there. They've borrowed over $1 trillion. So there's been a big spike in that since I think February with the Silicon Valley Bank incident there. So the banks know which liquidity routes besides going directly to the Fed discount window, because then that becomes public. They know which other liquidity programs to draw from, or the Fed just creates a kind of a new one. I mean, this one's it's not full QE here, but I mean, the Fed is loading out with the new one in February, 100 cents on the dollar for questionable assets that are maybe worth 70 cents on the dollar. They're saying that the banks are going to have to buy them back eventually. It's just a short-term loan, but they said the same bullshit back in 2019 during the repo crisis. They said that it wasn't QE. They said that the banks were going to have to pay back the loans quickly and take the assets back. And that's not what happened 2 or 3 months later. The Fed's official balance sheet was up by $1 trillion.
Right. So yeah, the FHLB is very interesting. It's basically turned into a bit of a bank slush fund, and it was definitely not what it was ostensibly told to the public, like what it was supposed to be for. Right. So that's been an offsetting impact. That's definitely helped to stimulate some of the tightness in interbank relationships that we've seen, some of the lack of trust that we began to see in late Feb and going into March. But on the other side of it, the bank term lending facility is actually really interesting, or bank term lending program is actually really interesting because, at least as it's described, we have folks that are going in there with a certain set of assets. It's only supposed to be treasuries that were bought before the program was created, and mortgage-backed securities that are backed by Fannie, Freddie, or Ginnie Mae, right? So these are all things that are backed by the full faith and credit of the U.S. government and are supposed to mature at 100 cents on the dollar. And granted, like you said, they're likely to have to take haircuts on these in the open market. If they were to sell these things, given where we were in rates then and how far out on duration and risk they had to go to get any kind of yield in this environment, they'd be out 30, 40 cents on the dollar. And so this facility allows them to go in, get 100 cents on the dollar, supposedly until March of next year. And they're paying about, at the current rate, they're paying about 5% to borrow against this window. So you think about it, they've got things on their books that are yielding 2.5, 3%, right? They're impaired in terms of what they're worth on the market. So they go to this window, but it also means they have a negative carry cost. So to borrow from this window, they're going to have to pay 5% against something that's 2.5, 3%. So they're losing 2.5% on that carry cost. So they're motivated to get out of that. And it's actually pretty easy. And I mean, it comes down to a common complaint that consumers have had for a long time. The rates on savings accounts and deposit accounts are a bloody joke. Outside of these money market accounts, you can't even get 1% at most banks. And the banks can attract depositors, which can increase their assets, which can offset the problematic mismatch that they have between assets and liabilities by simply attracting depositors. And they can do so at a lower rate than what the Fed's charging. So if the Fed's charging 5%, they come out with a savings account at 3.5%. That's better than you're going to get at a lot of places, or maybe 4.5. They want to be competitive and do what they're supposed to do, which is basically function as a utility. Then they could attract enough capital that the Fed discount window or super discount window lending program loan could be paid back, and they have a lower carry cost. And they could start to work through that if they attract enough capital to start to gain exposure to things like treasury bills that are very short duration that can at least give them a more positive carry cost as they start to kind of change their exposure to fixed income. So the real big thing here is, like, the Fed helped them to buy some time. It helped to reliquify them, but it doesn't fix the structural issues.
Well, I think the regional banks, their cost of capital is much higher than than the numbers you said. I think they're having problems at attracting new depositors. So if you're too big to fail bank, they're labeled something else, but we call them that. The listeners know that is too big to fail. Yeah. So if you're a JP Morgan Chase, Bank of America, Wells Fargo, Citigroup, one of those types of banks, your cost of capitals, it's up a lot, but it's still going to be on a relative basis way lower than a regional bank. And you're not going to have to pay a higher depositor fee because people are going to view that the cash in your account is safer. So you won't have to pay a higher yield out to new depositors.
Right, exactly. And so, if you're at JP Morgan, everyone knows that the Fed is never going to let them fail. And that really, if you examine the Federal Reserve objectively, they do tend to cater to the banking system. In fact, the regional Federal Reserve banks are private banks, and their boards are run by bank executives. So it's pretty important to contextualize that, if that's the situation, then of course they're going to serve those larger entities, and policy has done a very good job of that over the years. And that is also going to not be as advantageous for regional banks. And so their cost of capital is higher because people don't trust them, and they are definitely doing their best to try to attract new depositors. But I think that a lot of these places could still raise rates up a bit higher to maybe bridge that gap, and then maybe offer more exposure to money markets, or whatever, with maybe 10 bips that they take or 20 bips that they take for themselves. I mean, they basically got to get to a point where they're able to offer clients products that they want, that they're able to stand behind, and then also be transparent about, hey, we're taking steps to make sure that if X, Y, and Z happen, that you're not going to have your deposits in any way, uh, you know, have any kind of impact. Like, we've done stress tests, we've done whatever we can, but you also have to think about it from a totally different vantage point, which is outside of the largest banks in this country. The interest rate hedging instruments that we like, interest rate swaps, which is pretty much the only thing they can use, they're not even available. So if you're not a JP Morgan, Bank of America, Wells Fargo's, Citigroup, any of these really large banks, you're likely not even to have access to those instruments. And so that's one of the reasons that this was such a painful hiking cycle. Banks didn't believe it. And when they started to, it was already too late for them to get out of these assets without a major haircut. And the banks that did hedge, they were sitting pretty on a lot of this stuff because, at the end of the day, those swaps were able to pay out. But that was only about 6% of total bank assets that were properly hedged. So I think you're right that there is a big disparity between the money center banks, or as you call them, the too big to fail banks, which they are, and the regional banks, which are, unfortunately, I don't think that consumer trust in banks is going to come back anytime soon. It's at some of the lowest levels we've seen since the great financial crisis.
And the regional banks can't hold everything to maturity. They have to mark to market, especially if they have to do a capital raise or try to do a capital raise. And the regional banks also have net interest margin problems compared to a larger bank, too big to fail bank like JP Morgan. So we're seeing this in the investors' presentations. The regional banks have basically negative net interest margins, or they're razor thin compared to what they were, because their cost of capital is way higher right now.
Yeah, and unfortunately, that's not something that's likely to change anytime soon. I don't think that the steepness or the deepness of the current yield curve inversion is doing them any favors either, since they're typically borrowing from the shorter end and lending to the long end, and we're almost 100 bips inverted now. So I think, unfortunately, this is going to be a theme for the next year or so, that we're also overbanked as a country. We've got over 4,000 banks. That's more banks than the next 10 countries combined. So we do have probably some potential for, sadly, a lot of consolidation and some thinning out.
Well, some other countries only have 2 or 3 banks. So, I mean, that's not much of a choice or a market, and they're all 100% or closely fully backed by the government. They're like a state-owned enterprise. I mean, it's kind of here in the U.S. post 2008 with the too big to fail banks, but there were other options. But it looks like the balance sheets of those banks are in a lot of trouble now.
Yeah, and when you have, 13, 14 years of almost near constant emergency level monetary policy, and the Fed put under the market, and all of this backing for the financial system, a lot of bad risk management decisions and a lot of bad practices were made, a lot of reaching out far on the curve of duration and way out there on risk. And unfortunately, that set us up for where we are today. And I feel like, as you discussed earlier, we're not out of the woods on this. There is more potential for weakness, particularly in these regional banks. And for all we know, commercial real estate could be one of the catalysts for that. There's so much potential for that to be something that weighs even more heavily on these banks. And, in the overall banking system, just under 50% of banks have more liabilities than assets. And those numbers are meaningfully higher in these regional banks.
Yeah. Plus, corporate debt that has to be rolled over at much higher interest rates, junk bonds, collateralized loan obligations. So there's going to be a lot of small businesses and corporate debt that either needs to be restructured or will have some type of a default or a haircut because of higher interest rates in the not too distant future. And a lot of these regional banks have more exposure to the real economy and those types of loans than the too big to fail banks.
It's really quite alarming what's happening with small and medium-sized businesses. And, quite frankly, a lot of this commercial real estate debt as well is revolving. So as rates have climbed, the interest burden on their debt has risen and risen and risen, and there's been really no relief. I mean, yeah, so interest rates have not gone up at the last meeting, but that doesn't really provide that much relief given how far we've gone from zero bound to five and a quarter so quickly. And a lot of these small businesses, they're not only moving away from hiring, they're starting to let folks go. And we're starting to see some signs that they're not able to pay rent, that their delinquency rates on credit are starting to increase. So I would say absolutely right. Like, we're already at a point where the pressure is increasing because of those cumulative impacts from tightening. And unfortunately, small businesses are the largest creators of new jobs in this country. So if we're going to see a labor softening from anywhere, it can certainly start from the more vulnerable contingency that no one wants to fire people. But when you get into a situation where it's a choice between bankruptcy or closing your doors and letting some people go and hoping you have some more runway, you got to do what you got to do.
And this isn't making the case for fundamental improvements for a stock market bull market. So especially with the banking system problems, if the banks are not going to give out loans and expand credit, and there's problems with the banks coming, and then the real economy with small business growth and lack of job growth, and the consumer looks like there's a lot of evidence too that the consumer also looks tapped out with the amount of credit card debt and savings drained.
Yeah, over $1 trillion of credit card debt. Average consumer has about $5,500 balance on their card. And unfortunately, there's a lot of households that are buying necessities on credit cards because their cost of living has risen far more than their compensation. We've heard a lot about rising wages being a concern perpetuating inflation, but what we haven't heard a lot about is how real wage growth has still been stubbornly neutral to negative, really for the better part of 50 years, and even during this cycle of supposedly robust wage growth. So the average consumer is actually underwater, has less than $400 in savings, 60% of which of these same consumers are living paycheck to paycheck. 40% of that same contingency are behind on their bills. So this is a consumer that is starting to struggle, particularly the bottom 60% of income earners. And unfortunately, an economy where the consumer accounts for 2/3 of GDP contribution, that's likely to matter as well. And we see in the last several GDP prints, the consumer is not playing a meaningful role. It's really a lot of non-defense government spending. And in the last quarter of last year was that inventory build before holidays. So, we're seeing signs of a slowdown. We're seeing it in what people are buying. They're buying, like I was saying, more necessities, less discretionary. We did see that revenge spend trend in travel. I think that as we get through the third quarter of this year, that's likely to end as well. And I think that and combined with the services industry expansion that seems like it's on its last legs, once these things start to roll over, unfortunately, there's a lot of room for this elastic band that's been stretched so far. With every optimistic assessment of just how far this could go, I think it could go to the other direction in terms of sentiment. And then we start to see flows follow and then positioning. And we see a rather meaningful correction from these lofty, frothy highs into something that maybe more accurately reflects some of the near to intermediate term risk.
So I think some of the consumer staple companies like Walmart and Costco, they've come out recently and said that they've had more of their customers that were making six figures or higher. Those customers are going and shopping at bargain places or more discount places than they were in the past. And then the other sign we're starting to see, and there's been stories come out in this, I'm getting tons of emails too, whether it's Best Buy with electronics. Normally Best Buy would be loading up on inventory, big ticket items, so they could sell it for Christmas and the holidays. The opposite's happening. I mean, they're trying to slash the inventory like crazy with clearance sales happening in men's clothing companies, deep clearance sales, trying to clear inventory for cash happening at department stores. So it's kind of the opposite of what you normally see in a healthy economy with consumer spending. Even though consumer spending is high, I think a lot of it is, like you said, inflation. All this inflation that's built up for a while now, the consumer is paying high prices and still putting money in the credit card or spending, but it's because of inflation, the high prices, not because the wages are growing and the economy is doing well.
Yeah, and it's interesting because if you look at real retail sales, when we net out inflation, we see that they've been flat to down since May of 2021. So the consumer is spending more and getting the same or less, and they're spending it in areas that are much more conservative. And inventory has been a big issue. There's been a huge inventory overhang. It really started building up in the last quarter of 2021. Actually, they had really a lot of trouble selling it down in 2022, and then for whatever reason, they did the same thing in the last quarter of 2022. I guess, retailers were reluctantly optimistic that we're going to have this great Christmas, and they've been spending this whole time trying to work off that same inventory. So it's not looking so good. Because when you see that kind of depreciating asset just losing value in your warehouse, you got to mark it down, mark it down, mark it down until you find a market for it. And they're not. Consumers are tapped out. There was so much good spending that was pulled forward for the first year or so after the massive amount of helicopter money stimulus happened from the fiscal side, that people bought everything they were going to buy. They bought a new computer, they bought a new phone, they put a payment down on a car if they could find one, they bought new clothes, they bought new flat screen TV. You know what I mean? There's so much
they remodeled their house. Yeah, the Home Depot got big time business booming, and lumber liquidators and all those home remodeling companies.
Exactly. So much demand was pulled forward that it's likely we're going to see some slack in the aftermath of that. And I think that's another theme. You add the inflation to the pull forward. It's kind of like not only do people not want to buy it because they don't have the money, but they probably already have something and maybe they're just going to change their behavior. Maybe instead of, for example, buying an iPhone every year or two, they'll buy an iPhone every 3 or 4 years. And you might see that kind of cycle for other kinds of durables or other kinds of purchases where you can push them out. I know businesses are doing the same thing with their hardware refresh on the computer side. They're trying to limit the amount that they're buying. They're trying to push out those cycles to 4 or 5 years on computers rather than 2 or 3 years, as is often the standard. And I think that that all has a big cumulative impact as well. So we see these huge inventory overhangs in semis. I mean, you wouldn't know it looking at the stocks. You would think that we're in some kind of raging bull market for buying semiconductor hardware. But the reality is exports from Korea, Taiwan, from a lot of these big semiconductor companies, their revenues are dropping. We're seeing signs all over the place that that leading economic indicator of an industry is faltering as well. And, the AI bubble can account for some great growth story, but the reality is we're not really seeing it in the numbers.
I think the semiconductor, I think there's a geopolitical risk premium that China, mainland China, Chinese Communist Party and their army goes into, or Navy goes into Taiwan. So I think that's really kind of the inflated valuations there, because like you said, the fundamentals don't justify the valuation. So I think it's a geopolitical risk premium that China goes into Taiwan.
If they do that, though, remember that would be Taiwan Semi getting knocked down, and that would mean AMD, Intel, Nvidia, MediaTek, and Qualcomm, Broadcom. They wouldn't be able to get a lot of the fab they need. So these companies would be dead in the water for a lot of their offerings. So if we do really have a geopolitical event happen, this industry is probably, it may be one of the best times to hedge that exposure. If one's made a lot of money in semiconductors recently and is content to stay long, think about it from the perspective of what happens if that fabrication capacity of Taiwan Semi is taken offline even for a week or a month, the impact it could have on a lot of these companies and their products. And I think that it ends up being a kind of scary situation. So I'm sure everyone out there, and us included, we don't want to see that happen, but we do have to account for that risk because it is one that is growing. Geopolitical tensions are on the rise. Blinken just basically said he doesn't support an independent Taiwan. He speaks for the US. So we could see things get interesting, and we certainly aren't at a point where the reshoring or friendshoring effort has gotten to a point where we don't need to rely off Taiwan anymore.
Well, I think Taiwan Semiconductor was planning on building a large factory fab in Arizona. I'm not sure how far along in the construction they are, though. So those things could take years. So they're kind of behind on that. I mean, they should have been, Intel and those companies should have been diversifying into the US or Mexico in case of geopolitical risk.
Yes, for at least 2 decades now. I agree 100%. They should have. The one that they're standing up in Arizona is pretty interesting. They actually have some commentary out there I saw in the news over the last several months. And what it's led to is them basically saying, look, we're going to build it, but it's the output is going to cost more than we expected. So it's really only going to be appropriate for price insensitive clients. And they kind of hinted at, government essentially. Like this would be chips they could sell to the military and government agencies for specialized purposes. But this isn't something that would augment or replace the fab that they have in Taiwan. So we're kind of back to square one, and we're not seeing that crucial functionality replicated elsewhere. And that's the concern, because semiconductors in a technology driven world are crucial. They need to be abundant. They need to be available, or we can get into some pretty nasty situations. We all remember the chip crunch that happened in 2021 because of all these logistical issues. Well, that could be exacerbated if we have any key capacity knocked offline for a material amount of time.
Yeah, it's just not efficient to build a factory, especially like that type of advanced factory here in the United States anymore. It takes too much cost, construction cost overruns, red tape. So it's just not economic to build a lot of these factories. It's even worse for a nuclear power plant. I mean, we could have cheap electricity here in the United States, but now it takes almost 20 years of permitting tens of millions of dollars in fees to build 1 or 2 nuclear power plants. It's just a nightmare.
Yeah, and we still haven't figured out what to do with our nuclear waste, which should not be so much of a struggle. And we haven't even talked about, recycling that waste for one more use for lower grade power plants. I mean, there's so much to explore, and we need the power. We need the power. We're not going to get it all from solar and wind. It's certainly not going to come forever from fossil fuels. Nuclear is a very important component of the energy mix to consider. And the fact that so many countries, including the United States, are putting so many obstacles in the way, it's very unfortunate, because if we do it right, it's actually a very safe source of power, a very reliable source of power, and one that can scale to meet our growing needs.
So as we wrap up the interview, I want to get your thoughts then on commodities. If you think, or what signs are we going to be looking for that commodities are going to bottom?
So I think that the main story behind the rebound we saw in commodities from November of last year was the China reopening. And it didn't pan out. The China reopening has been disappointing, to say the least. And we're seeing signs that their economy is slowing further. Industrial production numbers, retail sales have been disappointing. We see that there's room for continuation in that disappointing growth year over year. But on top of that, China was using a lot of commodities to build these cities. And they're no longer building them because there's so much trouble in their real estate market, which is, by the way, I believe still the biggest market of any market in the world, around $65 trillion. Now, who knows how much of that's real and how much of that will be discounted. But the net takeaway is, if they're not building, there's a lot less use of key commodities like copper and energy, quite frankly. Now, China is still stockpiling oil. There's still a rather inelastic market in crude. So if we had a major supply disruption, crude could get back to triple digits very quickly. On the other side of that, however, we do have this global recession that seems ever more likely. I don't think we're going to have any decoupling anytime soon with China. Their effort to start a new credit cycle seems to be, shall we say, challenged. So I would think that would suppress demand for key commodities. So would some of the weakness that we're starting to see come back into emerging markets in these key export countries like South Korea and Taiwan. So with that, and then with the US doing some infrastructure spending, but overall it's kind of contained versus perhaps what one might expect, or what perhaps the country needs. I think my outlook for commodities right now is restrained. I have essentially a short bias for gold, silver, platinum, palladium, and copper's been technically behaving, so I'm neutral on it. I'm pretty neutral on oil because it can go either way pretty meaningfully, so I don't necessarily want to have a lot of exposure. I'm interested in looking more at natural gas. There might be some seasonality there as we get into summer and we start to see some more demand from the grid to keep this country cool. A lot of that power is created from natural gas, and it's traded from Henry Hub, where there's a pretty good amount of demand for Texas going into 120-degree heat. But I remain less constructive on the space. And I'll say one more. Softs, looking at grains, there might be some interesting opportunities there because of the drought starting to become a major issue. But zooming out, my thesis here really is that we're at the end of a credit cycle. And so commodities typically don't do very well in this environment until we get into the next credit cycle. And typically they do well late cycle. But my thinking on this has changed. And it's a theme that I'll be talking about in more detail on MacroVisor soon. But in essence, what I think we're going into is a time of structural scarcity. And it's going to be in energy, it's going to be in metals, it's going to be in labor, it's going to be in agriculture, it's going to be in capital. We see some of these themes already playing out, but they're becoming structural and secular in nature. And if you think about it, the irony of the Fed raising rates is it embeds inflation. It embeds inflation because people have to pass on an increased cost of capital, but it also embeds inflation because if you're running an oil company and you're told as the CEO that you have to decide whether you're going to increase or decrease production based on an increased cost of capital, high wages, and low demand. The no-brainer is you're going to cut production and you're going to cut exploration too, which hit the lowest levels in 75 years in 2021 for oil discovery. So what does that mean for us? It means that we can see demand drop meaningfully into recession, right? Fed policy can have the impact of killing the price of commodities short term, subduing the velocity of inflation, commensurate with policy goals, probably closer to about 8 to 10 months from now, maybe sooner, but it really looks like this is going to take a long time. Some of this inflation is going to be pretty sticky. On the other side of that, though, when we get into a new credit cycle and credit's becoming easier to access, but still expensive, but demand is starting to come back and they're pushing the economy. Maybe there's some fiscal packages that are also trying to stimulate growth. It's likely that commodity prices will not only rebound meaningfully earlier in the cycle, but also from higher troughs, right? Because there's still some level of scarcity here that's likely to be built into price. So I think what's likely to happen is as we get into the next credit cycle, we're likely to see inflation pick up earlier because those structural supply and demand imbalances are still very much in play. And there's still that lack of investment looking back a decade in a lot of these spaces. And labor is likely to be problematic. I mean, the labor force participation rate, each crisis tends to go lower and lower and lower. And that creates more tightness, artificial tightness in the labor market as well. So with all those key constructs, it tells me that inflation is likely to come back earlier and with some vigor in the next credit cycle. So my outlook is, for now, cautious. I like to be a little more short the industrial and precious metals for the short term. I like to be a little bit more constructive on what's happening with the softs here. But I just think that as we get into the next credit cycle, the commodities and the old economy stocks are going to be where the real leadership is, that it's going to be a total departure from the last 13, 14 years of, this market kind of being carried by tech and this idea that growth is really the factor to invest in. I think we're going to very much see that stuff invert, and it's going to be much more about value. It's going to be much more about free cash flow, and it's going to be much more about companies that are involved producing the things that we lack.
And even though we had higher oil and energy prices for 18 months, almost 2 years in 2021 and most of 2022, there wasn't a lot of new supply that came online. So the oil companies were just mostly taking that free cash flow and they were paying off debt, fixing their balance sheet. They were increasing dividends. They weren't focusing on going and finding new oil, investing in new supply. So there wasn't a lot of supply side investments for energy and for mining. So I think even though we did have high commodity prices, everyone's talking about commodity prices were high, inflation, the supply side investments, the commodity prices weren't high enough because it takes a long time for a mining company with high prices to go and make investments and bring a new mine online. And we're not seeing that right now.
Exactly. We're not seeing it. It takes high prices for a long amount of time, and they have to be high enough that companies are compelled. And the other thing they were doing, outside of the list of all the things that you had mentioned, is they were buying back shares, right? They felt that was the best way to handle capital. And unfortunately, it's led to a sort of self-defeating cycle. And we have more commodities out there. There's still more energy. There's still more base metals, and there's still more ways to grow agriculture and innovate in these spaces. But the money is just not being deployed. Like you said, they're not investing. And we've had over a decade of malinvestment in this space. And it's going to take years for energy, for base metals, for agriculture, and even for improvements in labor, because a lot of that sluggishness may only be resolved by improving immigration. It's certainly not like we're going to be able to grow our population of working age people. And if we don't have a deep enough recession, sad as it is to say, if this wealth bubble hasn't been wiped out, a lot of folks that have early retired are going to stay in early retirement. And that's going to lead to more tightness in that labor market becoming structural in nature. But even without that, demographics portend to the same outcome, because you do have a lot more aging people in this country, and population replenishment hasn't really been going as planned. So I think that at the end of the day, we've got some of the structural inelasticity that we're going to have to navigate. And I think there'll be opportunities in it, but I just don't think it's going to look anything like the kind of markets that we've seen for the past 2 or 3 decades. Inflation becoming a secular theme means different leadership. And I believe that the value factor and really the parts of the resource-driven components of the economy are going to be leadership in that type of an environment. But even pure commodity plays are likely to have, very good returns in that type of environment. But the other caveat is, if inflation comes back earlier, so does the Fed, right? So a shorter, more shallow cycle with compressed themes. And I think the leadership comes in the theme of really looking at what do we need that we don't have enough of and who produces it.
I think we've reached the end of I think we've reached the end of cheap natural resources for a lot of these commodities, because the commodities companies, the ore grades, the amount of oil discoveries that are cheap, low cost is just not there. You mentioned cost of capital. I mean, the cost of capital for a lot of these mining companies, unless they're a super low cost miner with a lot of free cash flow, their cost of capital is super sky high right now. So there's just a lot of factors here. And then on top of that, I cover gold mining extensively too. I mean, the gold mining industry, when metals prices, when gold had its last bull market back in 2011, they did a lot of really, really bad mergers and acquisitions at the top. They wrote off over $70 billion, the largest gold miners, in bad deals from 2012 to 2018-ish. So there was just tens of billions of dollars in bad write-offs. A lot of CEOs were let go. So the industry is not viewed, the bankers are not going to give them enormous amounts of cheap capital to do a lot of bad deals at this point. And even if they did do the deals, I don't just see a lot of new supply coming online because of higher labor costs, higher cost of capital. There's going to be some new supply, but it's not going to be a massive amount of new supply.
Yeah, really well said. The mining industry, I mean, some of the worst leadership in gold mining, I think, in any industry. It's just incredible how horribly everything was handled, and the way they did financing, the way they did M&A, the lack of exploration and discovery, the inefficient deployment of resources. It's staggering how much mining as an index has underperformed the metal itself when it's supposed to give leverage to outperformance during a bull market. But we are where we are. And then the other part of it I would add in is the higher cost of labor, the higher cost of capital, and also the increasingly restrictive regulatory regimes in a lot of countries not wanting this sort of NIMBYism. I don't want this mining or this oil exploration in my backyard. And so, it's not only gotten harder in ore grades and in, drilling down a mile or diagonal a mile or going out into the ocean and drilling down way into the, bottom substrate. But we've also gotten to a point where there's just places that don't want to even let us do any kind of drilling. And look, I get it. It's a dirty industry and all that, but until we have a viable, clean source of energy that we can deploy at scale, we don't have a choice. Most of the world's energy is hydrocarbons.
The policy decisions are also hypocritical. So you have these governments that are banning domestic oil and natural gas drilling. But if you look at the press releases the last 6 months, most of those governments that have banned domestic oil and natural gas drilling, they're announcing that they're going to open up a liquefied natural gas import facility. So where's the supply going to come from then if they're going to build this super expensive liquefied natural gas import facility? I guess they're just assuming that the supply is just going to magically appear.
Yeah, we'll be happy to sell them some liquefied natural gas at substantively higher prices than they can get at home.
Yeah, I guess it's good for Cheniere Energy and the companies that already, so Cheniere Energy is already, I mean, they went through this crazy stuff back in 2008. I remember it was unthinkable back then in 2008 that the US would build a giant liquefied natural gas export facility. Now Cheniere Energy is just booking deal after deal after deal and making money. Because of the higher interest rates now, you have the smaller companies that have a liquefied natural gas permit. They can't they don't want to use debt because the interest rates are too high to build new liquefied natural gas export facilities.
Yeah, so it's nice to have a corner in that market. I think Freeport got their facility back online too, right?
Yeah, I believe. Yeah. So the largest one, the Freeport ones, it's close to being back. I know 6 weeks ago, they said it was restarting. I don't know if it's back to full, but there's quite a few other ones permitted, but the construction, there's delays. I know with Tellurian, which was the guy who started Tellurian, went to Tellurian, he built Cheniere Energy and then he went to Tellurian. But now because of interest rates, they can't use debt to build the facility. So I think he just got approved enormous share dilution. So this is like the dilemma that the smaller cap companies, they already have the permit, the construction's underway. And because the Fed raised interest rates so quickly, they can't use debt financing.
Yeah, that's going to be a problem in a lot of these industries. And it goes back to what we're talking about. We just need to expand supply. But with capital being as expensive and as scarce as it is, it's unlikely it's going to happen commensurate with the needs that we're going to have moving forward. And unfortunately, we're not seeing anything from the government that resembles supply side economics. Quite the opposite with the Chips and Science Act and the seemingly ironically named Inflation Reduction Act, where there's not going to be any inflation reduction for the foreseeable future from this. But nevertheless, these are the things the government's doing rather than expanding the supply side at a time where they could. I mean, if we saw some programs to help the supply side components of the economy actually have cheaper access to capital, with the requirement that they expanded production and exploration, there could be some potential there, right? We've seen it happen in the past. It was one of the components of Reaganomics, and it was actually a response to inflation and structural supply side inelasticity then, just as much as we need a similar response now. Not that I'm a huge fan of having government come in and do these things, but if they are, it should be in the way where we're helping to resolve some of these constraints and not add to them.
There was supposed to actually be a loan discount program or low interest loans for liquefied natural gas export facilities. Biden was talking about it in speeches over 12 months ago. The program either was shelved, environmentalists stopped it, or it's just been delayed long. I mean, unfortunately, a lot of the energy policies here in the DC metro area, they contradict each other. So you have Biden approving oil production from ConocoPhillips in Alaska for the Willow project, which I'm sure the environmentalists are not happy about. But then they're subsidizing wind, solar, biofuels, still all these other stuff that I wouldn't really call those renewable because China destroys their environment mining rare earth metals and the other components.
Yeah, exactly. And that's the untold part of that story. And also that solar capture is not efficient. We're taking photonic energy at like a 22% efficiency rate, and 22% of that photonic energy turns into electrons that are then having to go through various forms of resistance as they're put through transmission lines and storage and otherwise. I mean, pretty much by the end of transmission, you're only getting about 15, maybe 10% of that total photonic energy. The rest is turning into heat. And that's kind of sad that it's that inefficient. And then it's also intermittent, and we don't have storage capacity or technology. I mean, it won't even work in colder parts of the country. The existing lithium storage or lithium-based batteries that we have right now don't perform well in those conditions. But the other problem is that this stuff comes at a high environmental cost, and it's just not efficient enough. It doesn't make sense from cost benefit analysis. Now, we'd be having a different conversation if it was 40, 50% efficiency, if we had much more modular, scalable battery tech, if we had utilities that were on board with deploying this stuff. That could be part of the solution, but it's never going to be the whole thing. And I think that's a tough pill for some folks to swallow, but it goes back to what you mentioned earlier. It's one of the reasons that we need nuclear.
Yeah, I'm a big fan of nuclear. The U.S. government, apparently for permitting and approval, is not. China's going to be building a lot of new nuclear power plants, although I think they permitted 2 new coal-fired power plants per week back in last year in 2022. But solar panels, I mean, it sounds good. And I see like the think tank people in the DC metro area come out with economic studies saying that solar is improving all this much. I mean, the panels are super expensive. They don't last more than 10 or 15 years. When you replace them, they're super expensive. There's problems now. We're seeing this with the state of New Jersey, the beaches offshore with the wind turbines. There's just all these problems with solar, wind, biofuels that a lot of the ESG industry is not talking about. They're intentionally ignoring them.
Yeah, and biofuels are basically just wood, so it's hard to call that renewable or clean.
or you're growing food used for fuel that's not efficient. You're destroying the internal combustion engine of the car, and instead of growing food supply on that land, you're instead using it for inefficient fuel, which makes no sense. And then you're driving food prices up for poor people.
Yes, yeah, the whole thing with ethanol is absolutely terrible. It's just it's a mockery of what energy policy should be, and it shows that this is one of the reasons that really we should have more involvement by markets and less by bureaucrats as it comes to our energy mix.
Oh, yeah, I 100% agree. Energy policy, whether it's European Union, the United States, United Kingdom, many other countries, it's just way overly politicized because each administration, and I've lived outside of Washington, D.C. metro area now for over 20 years, each administration that comes in, they all have their favorite energy, and that energy company gets all these extra contracts and subsidies, and it has this little boom, but then the next administration comes in and they're picking other types of energy to subsidize. So it's been this way for decades.
Yeah. Yeah, it's a dysfunctional dynamic, and in a country where the political cycle is changing every 2 years, it can get a little jarring.
Well, I want to thank you so much for your time today, Mayhem. If my listeners want to check out your work, follow you on Twitter, take a look at your newsletters, or subscribe to your new YouTube channel, how do they do so?
Sure. And thanks again for having me, Jason. I really appreciate it. It's been a lot of fun. So people can find me on Twitter at Mayhem 4 Markets. That's Mayhem number 4 Markets. The same on YouTube, youtube.com/@ Mayhem for Markets or Mayhem number 4 Markets. And then they can find my work at traderaid.com, where I'm focused on technical driven short to intermediate term swing trades, day trades, and also a bit of a macro top down focus. And then for the longer term, more macro focused investor and trader, the offering that we have out there is macrovisor.com, where we do deep dives in what's happening in the macro and make macro more actionable for all of our clients. And really the goal for everything that I'm doing out there isn't just to make quick money or to show people what to buy or when to buy it. It's actually more about education. So there'll always be actionable ideas, but I want to show people why we're getting to where we're getting, what the themes are, what the trends are, why it makes sense, and how to manage the risk in those situations. So it makes us a little bit different because we try to take an approach where it's not just show people what to do and sort of hold their hand, but actually teach them what's going on so they can replicate that process. And eventually they don't need any kind of help or service, but at least we help them grow to get to that point.
Excellent. Well, I really enjoyed our conversation as well, and we'll definitely have to have you back on in the future.
I would look forward to it, Jason. Thanks again.